Hi, this is Randy Finney with the right side of the chart, and this is a mid-session update for Monday, September 25th, 2023. It is 1:02 p.m. Eastern Time as I'm starting the video, so we've got about 3 hours left in the trading session. I'm going to keep this one limited to the equity markets. So what we'll look at are the main, what I call the primary indexes, the large caps, the NASDAQ 100 and S&P 500. And then we'll look at the Magnificent Seven. Those are the top holdings in the NASDAQ and S&P that account for the majority of the gains on both of those cap-weighted indexes. So starting out here with QQQ, as we were in pre-market, we were, as I said, hair above T1, and I always, in last couple years, I switched from actually identifying a target level, making an adjustment, what I called it. Always cover a short trade above, slightly above the support level that you're targeting in case a buyer step in early. So for all intents and purposes, that's been hit now. You can see that candle was close enough. And so we'll consider that hit now. That doesn't mean we can't go down anymore, won't go down anymore. It's just close enough that the buyer is likely to step in. And as, if not more importantly, what I gave you this morning on the NASDAQ, the 60-minute chart, here it was, that big level, T1 was set at the August 18th low, and then that, in the futures, we did hit. Remember, you're going to have a different levels, because number one, the futures are just that. They're futures contracts, so they're not going to track the NASDAQ 100 day by day, at the same point value, because there's a premium built in for that time value there. And then also they trade around the clock. I'm using these, the Globex, I used to call it Globex, and these trade around the clock. So you're going to have trades that did not appear in QQQ, which trades during regular hours, as does the index itself, the spot index. All right, so that's it. So we hit that level. Case was made. We have, it is a divergent low. It's still what I call unconfirmed divergence, because you have to see these PPO turn back up and put in a higher low. I'm going to show you what I think is the most likely scenario. That's what this is all about. There are no guarantees, but let me jump back to that QQQ chart. So this is what we look like here on the daily chart. I haven't yet eliminated the odds certainly went down, as I've talked about, with the breakdown below the trend line the other day. The primary uptrend line I'm talking about right here, that's the 2023 uptrend line taken out pre and then post-Fed, followed through, and that significantly reduced the odds of my marginal new high scenario, which says we go up, punch roughly equal or slightly higher high there, and then reverse. And that has been and remains my alternative, and it has lower odds than it did before the breakdown here. That's how it works. And when we break down a solid break below T1, that will, in my opinion, further decrease the odds that we're going to see new highs and help further solidify the odds that this high back here in July, mid-July, was the end of a bear market rally, and we're going to go down and hit all of these and then some targets down below there. So we'll see. But let's, that's kind of longer term stuff. As of now, that's support, and support, like I like to say, support is support until and unless broken. So with indexes remain above key support, traders always watch those key pivot reaction lows. There were other levels as well there helping to validate that level. When you look at the S&P 500 as well, I have two boards here. There, yeah. This is the board I've been highlighting recently. I'm going to make that line a little bit thicker, show you that was, I gave you red lines on QQQ, which again, T1 will be the red line where we, just below today's lows. And then these are the red lines, the ones that were the most significant levels, sell signals on S&P. So we've had a series of sell signals. We started back here. You had a bearish engulfing candle, then a breakdown of this bearish rising wedge pattern right there after the divergent high, sell signal 1. Then we went on to break the secondary trend line, the tertiary trend line, and now the primary uptrend line off the mid-October lows in the S&P. And so that one we're actually on right now, depending on how you draw it. You look, I have a board here. This is what I call my busy board, board number 1, or my scratch board. And you can see that that's it again. We're October lows right there. We come in, catch that March low, and we're right there. I will say that, it takes a third and confirming reaction, in my opinion, meaning we have to have a reaction here. Either we trade on it for a while or we bounce, and that'll help to validate that trend line. But there's also key support, price support right there. And again, on this board as well, you have, I had that other level on the other board right here, and that was set. See this little flagging type action there. We had 1, 2, 3, 4, 5 candles in a row with some consolidation, then we punched up through it. So that's also support right there. And we're in close enough proximity. We're pretty much right on the trend line now. We're at the top of this green candle, so that means we dipped slightly below it the way I have it drawn on this board, and we're on it. And if, again, I always say this, if you have to squint to tell if you broke down below a support level, then you haven't broke down below it. You want to see a clear breakdown to help solidify that. So that's it, guys. I think we're going lower, but I'm going to give you my best guess, and that would be, as I got the post out to you this morning, every day, and I try to do this even throughout the day, but especially on a weekend, I come back, sit down, and study the charts this morning, and that's what I saw. I try to come in with fresh eyes every day, and if I see something I didn't spot on, Friday or an hour before, then I'm going to get it out to you. So that was the case for a bounce. So far, it's a good bounce if not a decent bounce if you took it in pre-market. Let me show you where we were at. This is that 15-minute chart. I got out to you both ES, the S&P 500 futures, and NQ. This is the NQ 15-minute chart. So we had a divergent low recently right here. We had just divergence building, and we got a nice little rally there. And that same divergence from this point right here, where we had a divergent low, is now even larger, and that could easily indicate potential for a larger bounce, especially because, again, keep in mind, a divergence is not a buy signal by itself. It's just merely an indication that the momentum is waning and that a trend change may be coming. But what you can make a case to, it's not technically a buy signal, but it's an objective long entry, is a pullback to support. So that's it. So traders are going to look at these reaction lows like I just showed you there. It's about 14,800 on NQ. And so far they stepped in and bought it. And so you have a pretty good drop to support, near-term oversold with positive divergences. That's what I do. It's hard not to at least recognize that and either tighten up stops on shorts if you're not an active trader. And if you want to ride out, I'm going to give you where I think we might go as far as a balance, but that's it. You look for these little divergent highs. This is just my, active trading. I'm on a 15-minute chart, so the time frames or how long you're going to hold these trades are commensurate to the scope of the time frame here. In other words, 15-minute chart. This is not long-term 401k money, long-term investor, multi-week or multi-month swing trades. These are multi-day trades when you're trading off the 15-minute chart. Sometimes even just a few hours, within one trading day. Okay, so that's it. Let me go back to where I think we might go from here, and then we'll get to the big fangs. So when we look at the S&P 500, I've got a lot going on here. I told you there's also on the indexes, including QQQ, the potential for these head and shoulders patterns like that. And then you take the neckline, that would be your right shoulder, left shoulder, head, up here, right shoulder right here, and then neckline, and that broke down. But again, we're coming up on this support level here. So minor price support and a potential trend line. And then, of course, QQQ, you have a more significant, right there, that key reaction low. And so on the daily as well, you still have, and this is why I've not eliminated that potential marginal new high scenario, because if we can hold this level in reverse, you can see here you have equal or slightly higher lows on the indicators against equal, so far equal lows on price. And so that is a positive divergence right there. It's not the strongest divergence, but it could be enough to propel us up there. And what I think is, at least right now, as I speak, the most likely scenario, I have a different board here. Let me find it for you. Is it 5-minute chart? No, here's my 5-minute chart. It was on the, where did I put it? 60. Yeah, I was on my 60. Okay, here's my 60-minute chart of QQQ. So again, here's the 2023 uptrend line right here from the January lows right there. That's the one we broke. So that's a pretty powerful sell signal. We're below that trend line, and that comes off this divergent high here. We've been zigzagging lower since, although we didn't take out that low. If we take it out, anything, even if it is a punch down, a little whipsaw down through there, it could give us a counter trend rally. And where to? Well, that's why I'm doing this video for you. At minimum, I think right here I boxed in. Let me change the color of this tool and make that a box tool here. Okay, there's a gap right here. That gap is from, and then remember this is a 60-minute chart, so these are 60-minute candles. That's Wednesday's gap right there. And traders love those gaps, both the tops and the bottoms, and then once entered, a gap is often backfilled. So logical targets would be the bottom of the gap, which is, you just put a line there, and that's about 361.80, I recall it about 362. The top of the gap, that's about 364.60 or so. We're not talking a big, if you took it at today's lows where I laid out those, divergences and the fact we're at support, we get a bounce to the top of the gap, you're talking about 2.5%. So this is just, we'll call it my first target zone, or I'll label it up for you in case we follow up here. T1 zone. And remember, if we turn around and dump, I'm going to give you levels to watch in a minute, then yeah, we may go on down and really start to have the selling accelerate. I can't make a strong case for, I always try to speak to longer term swing traders and trend traders, as well as active traders. Myself being an active trader, but I also have other accounts, longer term accounts, that I don't actively trade in. I can't sign on, log into. They're with different brokers, spread out. And on those, I sit back and I do what most people on this site, I believe, are doing, and that's trying to catch the trends, multi-week or even multi-month swing and trend trades. And this is more active trading stuff I'm talking about here. So where we're going to go, I think today, tomorrow, this week. So T1 zone, right there you have it. And then you also have, if we carry on through there, and certainly from the scope of the 15-minute divergences I showed you earlier, there is the potential that we could carry up even more than that. And you still have this downtrend line off the highs right there. So let's just say this, minimum target right there, call it minimum target zone. It's so close, it's a relatively small gap. So we'll call that min target. And then max target would be a back test of the trend line. That could even come in with a back test of the primary uptrend line as well. You have your downtrend line here off the highs, and then you have the uptrend line here off the lows. And so that would be a max potential bounce target. I'm really not feeling that right now. I think we've starting to get some traction to the downside. And again, these were pretty powerful sell signals that we had recently. So you can call it trying to pick up nickels in front of a steamroller if you want, and that's kind of how I'm viewing this trade right now. So the takeaway is, if you're not nimble and active and can't really devote full time to this, and you're profitable from any or all of these, we've had multiple short entries from back here right off the highs. There was a trend line there, breakdowns along the way. So everyone's different. Some people might have a full short position from here that's comfortably profitable. Others might have been averaging down, waiting for additional sell signals. And some of you might not even be short, looking where to get short. And others, again, this is important. Some of you might be bullish, looking for new highs, have a different opinion than me. What I always say is that, nobody bats 1,000. I don't always get them right. But one of my skill sets is identifying significant support and resistance levels that are likely to, make a difference. In other words, if support's taken out, then that increases the odds of another leg down. And so if you take the opposite view, I might be as a longer term bearish right now, waiting for a break of that's that old T1 level, break of August 18th lows, to maybe add to more short exposure or add back if I'm long. Whereas someone who was bullish looking to buy dips and thinks this market's going to new highs and beyond, you can use these same levels and as support levels to buy pullbacks to, because that's TA 101. When you identify a support level, then at that point you determine, okay, if you're bullish, then you want to buy pullbacks to that support. If you're bearish, you want to wait for a break of that support to short. It's pretty simple stuff. Oh yeah, and before we move forward to the market leading stocks, here's that ES chart I got out to this morning. And ES or the S&P 500 futures, same thing. You know, we've pretty significant divergent low. And in a downtrend, it's just like during a strong uptrend, you can get those negative or aka bearish divergences, and they usually play out for a relatively small pullback that then gets bought up. We've been in a near-term downtrend since the markets peaked back in July. You know, the near-term downtrend, the longer-term trend or intermediate trend since mid-October or the beginning of the year in the NASDAQ 100 has clearly been bullish. So it depends on what time frame you're looking at. That defines the trend you're in. But this is the near-term trend. I'm not going all the way back to July there, but it's been stair-stepping lower. And you can see these divergent lows, you know, they played out for rallies. Active trader could have certainly capitalized on those rallies. They're just not very big. And so here we are. Last divergent low was right here. It was good for a couple percentage points, 1 or 2%. This one, it's a bigger divergent low, and it's also off that support I highlighted on NASDAQ 100 on the 60-minute chart. So we could carry up higher. And these are the levels I gave you today. So those are potential targets if you are gaming a bounce long. And again, try to align, you know, even if you're just a futures trader or just an ES trader or an NQ only trader, I think it's so important. I've learned over the years, keep an eye on all the charts of both the index ETFs, SPY and QQQ in that case, if you're trading large caps, and as well as the futures. And that way, because the reason for that is, let's say you're only trading futures, and so you're looking for a move up to 44.30 right there, right? And you're getting close, and you plan to take profits just shy of it, as you should. Always sell a little shy of resistance in case the sellers step in early. But right about when you get here, unbeknownst to you, maybe there's a big resistance level you don't see on the SPY or on QQQ or NQ. And then what happens is the sell programs hit. Everybody then closes their NQ longs and QQQ longs. The institutions, the robots, you know, the bots, you know, automated trading programs start firing off sell orders. And you're like, hey, how did we just reverse in thin air? There was no resistance here. So that's why I watch everything. And then sometimes we'll close out a position, take profits early if one of the related indexes runs into resistance or pulls back to support. Okay, now let's just look at the top leading stocks here in NASDAQ 100, and most of those are all are in SPY, and try to gauge where we're going to go. And starting out with the big dog, Apple. Apple is also an active trade. You have trade targets on it, and it looks like this. It's a busy board here. T1 was hit there. Right here, right off the lows on the divergent low, posted reversing it, came in a bounce here, hit those first one and then second target. Then you had a gap. There's an example of the gap. Entered the gap. I had the final target I had set at the bottom of the gap. We carried just slightly, you know, % or so above it and backfilled the gap and then reversed. And then so that, you know, keeps these longer term swing targets. So that's just an example of gaming counter trend bounce. As an active trader, that's what I like to do. I mean, if you get the call right, and supposedly, you know, Apple is going down from, you know, all the way to T5, that's a 36% drop. If you can cover where there's a likely bounce, I mean, that bounce in itself was 10%. So not only do you sidestep or avert a 10% loss or give back on your short position, which would have took you back to almost even, you turn around and turn it into a 10% gain. So you're really plus 20 right there, reversing that and then getting back short again. So sometimes it sounds easier said than done, and sometimes it's actually surprisingly easy. Just looking at the trade the technicals. Now, all right, where I'm going with this is we reversed but down here and never really considered T2 being hit, even though we were effectively close enough. So you could say it was hit. And because of that, where the relevance is, not that whether I want to count it as hit or not, the reason I list multiple targets is, and this is in the FAQ section on the site under resources, each target is a level where I think upon the initial tag of that level, in other words, on a short sale or a short trade, the initial drop is likely to produce a reaction. Once that reaction has happened, sometimes you get multiple reactions, sometimes you never, and that's it, and you never make it to the next targets because these are support levels. However, once the initial reaction has happened, then it opens the door for a break of that level on either the next visit or on subsequent visits to that support level, because we already had the initial reaction I was expecting. Okay, so now being that we got close enough there, we may punch on down through there. However, if I turn off all the lines here for a second, remember you have the key 200 exponential and simple moving averages right there. So there's quite a bit of support. You know, some traders, a lot of traders look at the moving averages. Some only look at price and trend lines and price support levels. Some traders only trade Fibonacci retracements. Some are Elliott wave traders and try to use wave counts. There's a lot out there, but I'd say the majority look at price support and resistance as well as the moving averages. And I certainly want to point that out. So this is what I see before there's a substantial rally. I think Apple has to come down, and probably, since we've seen a clear turn in the stock and a top, probably wants to come back and check those 200s at minimum. So even if you are bullish calling for new highs and beyond, I think it would help your case to see a successful back test of the 200-day moving averages. Again, I think that will get checked. I think ultimately, maybe sooner, maybe later, they'll get taken out. The other thing to note too on Apple is if we can punch on down, and this is why I favor, I don't think there's going to be a very big bounce. In fact, the bounce could be over today already. We already hit, I didn't cover that earlier, but let me do it. I gave you these targets this morning on NQ. We already hit the first one at 14,925. Okay, this is the chart I got out to you this morning. Took this screenshot right before the opening bell. There was a divergence. There was a case. So these are my arrow breaks. First target, 14,925 and a quarter, 15,022, and then currently, that's a max bounce target. But this is pretty stiff resistance. And I'm going to say it wouldn't surprise me if this is all we get out of there, because we're getting so close to those targets. Again, that was this morning, 14,807. That was then. This is now 14,807 was right here. It's not much, 0.85, so almost a 1% pop. But again, it's at the first and minimum resistance. And in a downtrend, sometimes that's all you get. Again, these 15-minute divergences, positive divergences, don't play out much. I don't like to, I'm certainly not trying to call a bottom, just looking to game a quick bounce, which so far I've done. And at this point, I won't go negative, be stopped out at minimum for a little bit of a profit. And, but what happens is, from experience, once a downtrend starts to get traction, once you get close to those bigger support levels and the moving averages, it tends to be like a vacuum. I think we're going to get, again, whether we bounce a little more or not, and I gave you the bounce ranges on the indexes, I think we're going to come on down and punch down. And it's not just Apple. Let me look at the rest of them. That'll make it a little more clear what I see here. I want to do one thing for you as I go through, and then we'll wrap up. I'm going to use two time frames, the daily, which we were just looking at on Apple, and the 60-minute chart. So here's my 60-minute. Same primary uptrend line Apple. It's the 2023, just like everything. Most of the big fangs bottomed in the beginning of the year, in the beginning of January. And we were long and strong there at the lows. Breakdown, back test, and rejection. T1. These are just the targets on the 60-minute chart. But see, this is a support I added on August 17th, and I revamped that recently to add that T2. It's a little bit lower, and I could see us going down there, and I can even see us slightly undercutting, giving us positive divergence right here. I'm going to draw it out. We would have, and it would actually come from this point here, if we can punch on down there. So we currently have some divergence right here. But again, I'm just giving you what I think is a very likely scenario, that we punch on down, we get another drop here soon, whether we bounce a little more first or not, slightly undercut that level, and then put in a bigger divergent low in which to rally with on Apple if these divergences right here from here to here are still intact. So keep an eye on that. And again, it's So I see minimal downside before the buyer step in, but I do think we're probably going to get that one more drop there. Okay, so those are your levels. Screenshot, replicate them if you want on the daily, as I just showed you, different boards daily in the 60-minute chart. Here's the daily of Microsoft. Microsoft highlighted this back at the time as a potential blow off top right here, and that's certainly proved so far to be what it was. We've been stair stepping lower, and may have another cleaner board here, but the key levels recently was this little trend line here, and then you had a wedge formed right there, and we broke down. It's been nothing but red sticks since the breakdown there. Pretty impulsive selling. And the next, I'm going to add a level here because there is a reaction low. And again, it's that big August 18th low was important in a lot of stocks. And so we're coming up, but we haven't yet hit that. And that's why I can see a little more downside here in the indexes. And maybe those 15-minute divergences I got out to you this morning just grow a little larger. And then we get the divergent low on the Apple 60 I just showed you a second ago. All right, so that's what it looks like there. And again, it's I'm doing this because I look at these collectively. I like to see, I much prefer to see the majority of these big 7 top, tech stocks all hitting or very near support around the same time. Microsoft has yet to hit that August 18th low, and it's still above these 200-day moving averages. And, if we punch down a little more than that, this is even bigger support all the way down here at 293.60. So that's the daily chart. Here's how it looks on the 60-minute chart. There was a trend line right here. I guess I haven't updated this one in a while. I'll take that trend line and extend it. So that's it. You had a breakdown there, back test. There was that little wedge I showed you on the daily. And here's support right there on Microsoft. If that support goes, there's a big old thin zone. I don't really have much support until all the way down here about 291.84. But again, watch the moving averages on the daily chart. That's the 60-minute chart of Alphabet, GOOGL, Class A shares. Beautiful bearish rising wedge. Just broke down. And we're at pretty good in my first target on the 60, support zone right there. But based on the scope of that wedge, you would expect more downside ultimately. So again, if we take that level out, then we'll probably head on down. There's a top of a big old thin zone. That's pretty important right there, about 116.20. Pretty significant support. So that would be a near-term target there. Here's what it looks like on the daily. The daily chart supersedes the 60-minute chart, in my opinion. It's more technically significant what happens there. And there's your big old, what I call, again, a beautiful bearish rising wedge. It just doesn't get any better looking than that. And we only just broke down. So you can see the breakdown, solid. We're well below the trend line. It's a third day trading below the, what we really broke down last week right here on a Wednesday. You close below it, and then we had follow through red. So this is day 4, and that is 100% confirming that breakdown. It doesn't guarantee it'll stick, but it increases the odds. And technical analysis tells us that's just the start. Widest part of the wedge is your measured target from where it breaks down. That would take us down to at least this support resistance zone there. But we have pretty good on the daily, pretty good support here. And here's the thing again, we're not there yet. That's good support. It was resistance, this little box here. It was a trading range. Tested it again, rejected. Finally a breakout candle, back test, back tested it for weeks right there. Very significant. And again, from my experience, when you get that close, it's almost like a black hole. Or putting two magnets together, and you get them close enough, they just kind of snap together. You get that gravity pull, and so that's where I think we're going before we get any decent bounce. So to me, it's a matter of, are we going to get, and they certainly could, a little counter trend bounce here up to the gap, either bottom or top, and then go down. But I do think, and again, it is, in my opinion, a kind of a picking up nickels in front of a steamroller thing. I put pretty good odds we're going to go down there before a meaningful bounce on Alphabet. Or at best right now we're looking, if we test the bottom or the top of the gap, you're looking at a couple percentage points. Amazon, busy board here. Let's see if I have a clean board. No, I don't. Lots of levels, but most importantly, divergent high like everything else. And again, it's these big divergences in the data. Last time we've had negative divergence of this scope and magnitude was back in 2021 when the NASDAQ topped in November. and a lot of these stocks topped then, and we had the 2022 bear market or correction, whatever you want to call it. I call it an initial leg down and a much larger bear market, and this whole thing since the January lows here and these big things just being a counter trend rally. Turn off all the lines, say what you want. One of us will be right, one will be wrong. I think it's a bear market rally. Others have declared it, too big to be a bear market rally, new bull market. But I look at the long-term charts, weekly charts that got butchered when Amazon, every time on this charting platform, every time a stock splits, I don't know why I paid good money for this one, and they're living in the 80s or 90s where they just don't adjust the trend lines for stock splits, and then you got to pull them all down again. It's crazy. But anyway, I did adjust the primary trend line, and that's the thing here is Amazon. This is our secular bull market trend line, which was taken out back here, and we're well below that. So to me, this and many of these stocks are going a lot lower. That's just big picture stuff. But most of this video, I'm just focusing on the very near term and showing you on a stock like Amazon, which most recently broke below this minor trend line after the divergent high and other sell signals. And this is, it's not great support. In fact, that's why this chart's so busy. I don't have some very clean support levels and trend lines like I do on the other big tech stocks. NVIDIA, that one's pretty clear to me. Oh, wait, let me go back to Amazon. I might have missed anything on the 60-minute chart here. No, same old, divergent high, negative divergence. Next support down here. Let's go to NVIDIA now. I'm doing these in order of market cap. NVIDIA put in divergent high right here. Big negative divergence. I see a lot of downside in this stock in the coming years. I know it's a crowd favorite right now on Wall Street, poster child of the AI bubble. But to me, I see just a lot of downside in this one. Uptrend line right there, breakdown, back test coinciding with the divergent high. So far rolling over the back test at support right now at 403.30. Pretty good support too. If you zoom in, it was this little trading range here, then support. If that breaks, or when that breaks, next support 375, and then the big old gap down below, and then the primary uptrend line. So those are the levels of what needs to happen. If we rally anytime soon, here's your near-term downtrend line on the video right there. That should come in as resistance. If that doesn't, next resistance is about 440. 60-minute chart, same downtrend line, same uptrend line, broken. So NVIDIA, again, whether we get a near-term pop or not, looks like more downside in the coming weeks, days to weeks to me. And then Tesla. One of the most significant things here is a primary bear market downtrend line right there. Most recently, as expected at the time, we got rejected on that rally into it. We had a sell signal there. It was an objective short entry. We had negative divergence. Got rejected off there. Excuse me, rallied back. And I know it's a busy board, but we just recently took out this minor downtrend line, and it's rolling over. So it remains below its bear market downtrend line. And let's see if there's anything on the 60. This is, again, the realm of the more active trader. Look for these divergent highs, trend line breaks. We had a short pullback trade there. Both targets were hit. Downtrend line broken. That was a buy signal. Uptrend line broken. Sell signals. Divergent high, correction. Divergent low right here. Rally. Divergent high, correction. Blah, blah, blah. All right. What's next would be... Okay, Meta. And Meta had a beautiful, very steep, overextended uptrend line off the October lows. It led the rest of the big tech stocks. Big old negative divergence, put in a divergent high, breakdown, beautiful textbook breakdown, back test. Here, I'll zoom in for you. Doesn't get any better than that. So there's the breakdown, back test, rejection, and like all of them, it's been in a stair-stepping down, or at least from this high here, and needs to take out the recent lows. I don't have the 60-minute chart doesn't show much here either, but about 290 is support there. Bottom line, from the look of the daily chart, this is going a lot lower. I still maintain all these targets I've had for a while here: T1, T2, T3, and potential T4, T5. And if and when we get down there, I'll probably add additional targets. We'll see. Before I leave here, Tesla reminded me of one the former big semi, and it no longer holds that title, but Intel. And so Intel is a great example of, here's a stock. It was my favorite of semi, and one of my favorite stocks altogether down here off these October lows. And again, earlier in the year, we swung it up. I had a couple trades here. And then I highlighted that if it took out the top of this range, which it did, ultimately broke out, that it could go on to test its bear market downtrend line. So that's similar to the one in Tesla. And it did. It recently popped it. And somebody inquired about it, and I shared my thoughts too. As I said, any breakout here, it's going to have negative divergence. That breakout's likely to fail. See, that happened on a divergent high, and we rallied up to that next resistance there at 40.50, and then boom, and now it's failed the breakout. That's bearish. It's quite bearish, actually. So this is a stock clearly in a bear market, well off its all-time highs and multi-year highs. And, you know, by all metrics, including Fibonacci retracements, it's just a counter trend rally. And again, it tried to pop. That should have been bullish. It should have stuck if it was the real deal, but it didn't. And it didn't do so because the technicals said it probably wouldn't. And now it's back below there. And so, you know, so for Tesla, again, Tesla's also, you know, tested, but Tesla has yet to break above its bear market downtrend line right there. Just wanted to point that out. Okay, guys, so that's it. Near term is a little bit opaque as to where we're heading. Like I said, you have the divergences on the 5 and 15 minutes and even the 60-minute chart of the futures right there. You know, so again, whether we get a little more, we've already gotten a bounce. We had, again, about a 0.85% bounce where I looked at it this morning. Whether or not there's a little more upside or not, if we do have another jog down and some of those big market leaders hit support and the NASDAQ punches down below that August 18th low, as long as it happens soon, that's a condition with these divergences, because if it took weeks, then it's not going to look like this. But if it happens soon, we could have a nice divergent low, a better looking. This is very steep divergence. It could play out, but usually you get something more like this. And so that would entail a little bounce and then punch down through there. Probably suck in some shorts, clear out some of the stops on longs when that August 18th low is taken out. That could set the stage for a little a counter trend rally with a little more teeth. But let me just say this, and again, I don't want to sound like it's double speak here. You can't rule out this was a very overextended run. As others, and I guess we all see what we want to see. Fundamentals right now in the economy and the market, clearly to me, don't support where we are in the stock market. It seems to be very overvalued. It's pricing in almost perfection as far as earnings and everything else goes. It's completely discounting where interest rates are right now, where the 10-year Treasury and other things are. I see red flag, yellow flags turning to red flags all over the place, including but not limited to things on my, things to watch list that I've shared with you recently. Things like, California muni bonds now taking out that low. This is one thing I've been watching for a while. Whereas MUB, the national, one of the most diversified national muni bonds, still well above its October lows. So that tells me that California, the largest, one of the, again, I don't know where it is now. In recent years, it was the 7th largest economy in the world, bigger than a lot of countries out there. This is saying, hey, something's wrong, and again, we're not talking, North Dakota here or something. It's not, offense if you live in North Dakota, but it's not going to take down the U.S. economy. Problems in California, and I could see it easily. These are things that I think will pop up in the headlines soon. Problems in California, problems with CalPERS, the largest public pension fund, which of course the state's on the hook for, state taxpayers on the hook for. And so these are the things I'm looking at. So I see, again, we all see what we want to see. I see a lot of reasons that when these problems happen, and just developments, trends. I'm looking at retail sales, not just overall. When you dig down into the retail sales, as the big retailers have been reporting, consumers have been, whereas some can say, oh, the numbers aren't so bad, but then when you dig under the hood, big ticket items, consumer discretionary is dropping off, and they're seeing more and more pickup in the staples, and so it shows, dollar store and Walmart, things like that. People are, bargain shopping right now, buying more necessities, and consumer debt being at credit card debt swelling right now. That's not a good sign. Somebody asked me, I saw, and I didn't have time to answer yet, about my thoughts on the debt ceiling. That has been, and it seems to be a recurring and accelerating theme. When you read up on this, the carrying cost for the U.S. government to service its debt, these high rates that we have now, especially on longer term bonds, and everything out, even the short term bonds, of course, if the Fed raised short term rates. So everything from the 1 year T bills, 5 year, 10-year treasuries, out to the 30-year, our cost to service that debt, even at this point, is having a big impact on the budget. And I heard, I can't cite the year, it was 2040 or something like that, that the cost to service U.S. debt is slated to, or on pace to exceed that of both military spending and I believe social services. Maybe it was Medicare. I have to look into that. I heard the stat, and it was pretty scary. And this is the 10-year breaking out now. It's done it. 10-year bond has broke out to new multi-year, even multi-decade highs. You have to go back quite a ways to see the 10-year yield at this level, all the way back here, back in the last financial crisis. So, a lot of, again, the stock market, whether the Fed has come out and done the whole declaring victory on the war inflation thing, the stock market most certainly has. Again, the stock market, in my opinion, has been playing a game of chicken with treasury bond yields and interest rates. And so far, treasury bonds haven't blinked. So, we're back to where we're back above the 10-year yield, and the 30-year yield, I believe, are now higher than they were when the stock market bottomed in mid-October. The stock market bottomed in mid-October because that was the spike high in rates. And only once the trend line broke and interest rates started falling did the stock market turn around and put in that very significant bottom in mid-October. And so from just that one aspect, it makes no sense why the stock market would be much closer to a 52-week high than a 52-week low right now, when bonds just took out their yields just took out those highs from mid-October. So that's it. So that's more fundamental stuff. But again, the first part of the video, or most of it, was spent on the technicals, so you have the levels to watch. And all right, we'll pick it up from here. I'll continue to dig and try to find some more trade ideas, and I'll do some updates on the metals, miners, commodities, oil, natural gas, and all those other things we're watching, and get a video out to you as soon as possible. This has been Randy Finney with Right Side of the Chart. Have a great day.